Welcome to your own channel, Romance with Finance, a brand of Financial Freedom Hub. On this channel, you get the videos and information related to personal finance.
Love to read books? Go and grab this book on mutual funds. Click on the below link and grab your copy today.
Assuming a group of four people. Out of those four, one want to go to Delhi, another to Jaipur, the third one want to go to Agra, and the fourth to Chandigarh. All of them need a vehicle. Now each of them has two options. Either everyone buys a separate car or they pool their money together and buy one comfortable SUV. Naturally, buying one SUV together is much more practical. Each person contributes some money and in return, each gets a seat in the vehicle. Nobody owns the entire SUV. Everyone owns a part of it. Now, what if instead of buying a vehicle, they decided to buy a business? That is where an equity mutual fund comes in. Imagine you wanted to own India's biggest companies like Reliance, TCS, HDFC Bank, Infosys, ICICI Bank, etc. However, buying all of them individually requires research, monitoring, and huge money. What if someone could build a diversified portfolio of these companies for you? That's exactly what an equity mutual fund does. In our previous video, we learned that mutual funds are classified into different categories. Today, we are starting with the largest and most popular category, which is equity mutual funds. Let's understand what they are, how they work, and why millions of investors choose them. An equity mutual fund is a mutual fund that invests primarily in stocks of the companies. Just like those four friends, an equity mutual fund also brings people together. Except instead of four people, there could be thousands or even lakhs or even crores of investors. Everyone contributes whatever amount they can afford. Some invest 500, some invest 5,000, some invest 50,000. All this money is collected into one common pool. When thousands of investors contribute money, the fund manager uses that pooled money to buy stocks of various companies. Instead of owning just one company stock, you directly own a small portion of many companies through mutual funds. Remember, you do not directly become a shareholder of those companies. You own units of the mutual fund, and the mutual fund owns the stocks. So, indirectly, your investments are linked to all the companies the fund has invested in. The more units you own, the larger your share in that mutual fund. Let's assume you invest all your money in just one company. If that company performs well, that's great. However, what if something goes wrong? Then your entire investment suffers. Now imagine your money is spread across 50 or 100 companies. If one company struggles, other may perform well and reduce the overall impact. This is called diversification, one of the biggest advantage of equity mutual funds. Now you might wonder, if the mutual fund is buying companies' stocks anyway, why don't we simply buy the stocks? That's a great question, because selecting good companies, deciding how much to invest in each, knowing when to buy, when to sell, requires time, research, experience, and continuous monitoring. An equity mutual fund does all of that on your behalf through a professional fund manager. You simply invest in the fund, and the fund invests in companies.
How does an equity mutual fund make money?
The primary source of return in equity mutual fund is capital appreciation. When the companies in the portfolio grow, their stock price rise. As the value of the fund's investment increases, the NAV of the mutual fund generally increases too. And if you redeem your units at a higher NAV, then you earn a profit. Some companies may also distribute dividends to the mutual fund. However, for most equity mutual funds, long term growth in the stock price is the main driver of returns.
Why shouldn't I just buy the stocks myself?
Since equity mutual funds invest in the stock market, their value moves with the market. Some days your investments may go up, some days it may go down. That's completely normal. Higher return potential comes with higher risk. That's why equity mutual funds are generally considered more suitable for long-term investors rather than for those who has a very short-term time horizon. Hope this video was useful to you and you have learned something today. If yes, then